The lowering interest rates are caused by the ever-growing income inequality. The gap between the 10% highest earners and the rest keeps on growing over the last few decades, and it causes prices to rise. But most importantly, it keeps interest rates low and it pushes them lower and lower. What's up everyone, my name is Joris, welcome back to my finance channel. Last week during the Jackson Hole Economic Symposium, a study by Atif Mian, Ludwig Straub and Amir Soufi was published with findings about the link between the income inequality and the interest rates. This gap is ever expanding, and because the rich are saving more and more, interest rates are presumed to drop because of a lack of spending of the money. The savings and of course the investing then supports the asset prices, which makes the rich even richer. During the 80s, economists are questioning the phenomenon of ever-dwindling natural rate of interest. The paper talks about R* as the natural rate of interest, which shows the interest rate with which the economy is in equilibrium, without stimulus plan or economic cooling. According to many other reports, the structural decline in interest rates is caused by the mass of savings, also known as the savings glut. This overdose of savings pushes the interest rates down, interest rates that are needed to restore the equilibrium between savers and lenders. This can already be easily seen on the bond market. The more money that is flowing into the bond market, the bigger the demand, and the higher the prices of current bonds will be. But most importantly, the lower the return of newly issued bonds. Companies and countries can get away with giving a lot lower returns on their issued bonds since there are enough investors in the markets anyway. There are two main theories about the origin of the savings glut. One of them focuses on demographic development, in particularly the baby boomers generation, the people that are born between 1945 and 1964. During the last few decades, they saved for their retirement, and their massive savings, combined with their big share of the total population, has had a major impact on the interest rates. The second theory focuses on the ever-growing gap in income in the population over the last 4 decades. Coincidental, the same period the interest rates are starting to drop. The reasoning behind this theory is that the rich keep saving a bigger portion of their income. And if these savings and investing accounts keep increasing compared to the rest of the population, who spend a bigger part of their income on everyday life, the interest rates are going down. And this last theory is now supported by the paper of Mian, Straub and Soufi during the Jackson Hole Economic Symposium, the yearly financial conference hosted by the Fed. They researched the savings habits of the American families between 1950 and 2019, and they concluded that the income inequality dominated as a cause of the drop in interest rates. They further found out that the 10% highest incomes in every generation have seen their income, and their savings of course, rise exponentially since the 1980s. So they noted the phenomenon of lowering interest rates, and they linked it to the gap to income spreads over the generations. The 10% highest incomes also save the most, by far. The top 10% save on average between 1 and 5% of the national income ratio, while the next 40% save around 1% and the bottom 50% don't seem to save at all on a national scale. The top 10% saves at least 5 times more than the next in line, and these savings are expanding over the years. The paper estimates that the 10% highest incomes are now saving an extra 3 or 3.5% of the national income ratio compared to the 1980s. They're saving a lot, and they are saving more and more. There's a huge difference between the savings rate of the top 10% incomes compared to the rest, where the top 10% save around 21% throughout 1953 to 2019. The bottom 50% only managed to save 1.5% of their income. There is no real difference between the different ages throughout the years. As per usual, the older you are, the more you are saving. And once people are retired, their savings starts shrinking. They're spending more than they are earning. The main differentiating factor here is the income. and not their age. The paper states two main conclusions. The first one being that the central banks and their low interest policies are not the main reason for the inequality. It is often said that central banks with their policies are supporting asset prices and are supporting investors looking for returns on their investments. The paper's findings suggest the opposite. The savings rate of the higher incomes boost the market. The Fed and other central banks and their policies have an impact on the interest rates, but they are just adding more fuel to the fire. The paper suggests the policies are not the main reason for the lower interest rates, but they do contribute to them. The second conclusion is that the low interest rates are pushing asset prices, from which the rich are profiting, which also supports the inequality and pushes the interest rates down. As you know, these asset prices include the prices of stocks, bonds, real estate and other listed investments. In recent times, we have accepted price-to-earnings PE ratios that are a lot higher than they used to be. And the real estate prices are also through the roof. This is not new. What is apparent from this paper is that the financial inequality, both in income and in savings, is a vicious circle. The rich keep getting richer and the poor remain poor. Basically, this paper proves it scientifically. This does not mean that all the rich stay rich and that all the poor remain poor. As we have seen in previous videos, a lot is dependent on your own personal finance. As you can see, even the top 10% only save around 21% of their income over the years, on average. So if your savings rate is over the 21%, you're doing great. And no matter where you came from, if you succeed in keeping it going, you will end up where you want to be in the future. So, what do you think of the findings of this paper? I will link the paper down in the description below, by the way. Do you blame the money policies for the lower interest rates, or do you agree with the paper's findings that the savings of previous generations are boosting asset prices and pushing interests down? Let me know in the comments below what you think. If you've enjoyed this video, you know what to do. Please leave a like for the YouTube algorithm, subscribe to the channel and hit the notification bell to be alerted when a new video comes out. I thank you very much for watching, and I will see you in the next one.